from the BBC World Service with me, Ruth Alexander. Each week we bring you 4 expert witnesses answering one pressing question from the news. This week we delve into the Paradise Papers, millions of confidential documents that have been published to reveal the tax haven secrets of some of the world's richest individuals and companies. We're focusing on just one name that's emerged from the pile. You'll have heard of it. One day in late March 2014, the sound of an email pinging into an inbox was heard simultaneously in the British Virgin Islands, the Cayman Islands, Bermuda, Mauritius, the Isle of Man, Jersey and Guernsey. It contained 14 questions about the tax advantages for a company choosing to base itself in any of those places. Not just any company, one belonging to the tech giant Apple. A ripple of excitement went through the air. The world's most profitable company appeared to be searching for a place to put its money, a place where it could avoid tax. Emails that followed stressed that Apple wanted to keep all this secret. The whole world has now found out. The emails were published alongside millions of other confidential financial documents earlier this month. Apple avoids tax was the headline around the world. It's by no means the only multinational to arrange its finances offshore. And when some of the world's biggest and best-known companies operate out of tax havens, it raises serious questions about whether something needs to be done. Less tax paid means less money for our schools, hospitals and roads. In this inquiry, we're shining a light on the financial arrangements of this one household name to highlight how companies find a way to dodge round international laws. We want to know, why doesn't Apple pay more tax?
Part 1. Taxes paid in the USA.
I've uncovered various accounting frauds through the years, and so I'm a bit of a sleuth in that sense.
Our first expert witness, Albert Meyer, is a forensic accountant whose intimate knowledge of accounting rules has landed people in jail.
It's a discovery process like any forensic detective.
Albert Meyer's looked at Apple's latest financial statements and found no such issues. In fact, the tech giant likes his analysis so much it's been giving it to journalists as recommended reading. So Albert Meyer's going to help us understand how much tax Apple pays in the United States, the country where the company first started up. What proportion of its profits does Apple make in the US and what proportion abroad?
About 70% of its profits come from abroad, and about 30% is US-based.
So let's think of the money Apple makes as a delicious apple pie, cut into 10 slices. 3 slices of the pie are made in the US. How much of those 3 slices should go to the US government?
The statutory rate in the US is 35%, and then the tax code allows for all kinds of allowances and credits and so on to bring that tax rate down.
For example, if you invest some of your profits back into research and development, your tax bill will go down. For Apple, this cuts the rate it pays by a few percentage points.
The effective rate is 31.9%, so they pay a full tax on their profits.
So on Apple's US profits, is it fair to say they pay all the taxes due?
Oh, absolutely, absolutely.
And looking at all their tax affairs, from what we know, is everything they're doing legal?
Oh, everything they do is legal, absolutely.
So of the 3 slices of pie Apple makes in the US, one of them goes to the US government. What happens to the other 7 slices of pie, the profits it makes overseas?
They get taxed on their worldwide profits, but they get credit for taxes that they paid to foreign governments.
So the foreign country where Apple has made the money gets first bite of the pie. Apple has to pay corporate tax to that country's government. And then the US government gets its bite. Why doesn't Apple pay more tax?
Because it doesn't have to pay more tax. It pays all the taxes that it's legally committed to pay and obligated to pay.
So why all the fuss? Well, let's take a trip overseas to meet our next expert witness and look a little closer at Apple's tax arrangements outside the US.
Part 2. Taxes paid overseas.
I have to say that I really do like my Apple iPhone, and I do use it rather too much. I open it in the morning and I close it when I go to bed at night.
When she's not glued to her phone, Emma Hunt lectures in international tax law at University College Dublin, in Ireland, where Apple has long had a base.
Since the 1950s, Ireland has built an industrial policy on attracting foreign direct investment through, partly, their tax system.
Ireland's tax rate is attractive to companies because it's low. It's about a third of what it is in the US.
In 1980, it attracted Apple to establish itself in Ireland. And from very small beginnings, it's grown to employing some 6,000 people in Ireland.
In the 1990s, Apple took its business in Ireland a step further.
Apple rooted its corporation tax structure through Ireland by establishing 2 non-resident subsidiaries.
These 2 companies held the foreign rights to the most valuable asset Apple owns, its know-how.
Those 2 companies were the holders of intellectual property. The value of Apple is not in the little phone or iPad that we hold. The value in Apple is in the intellectual property that goes into creating that product.
Apple was able to funnel the profits of all its sales outside of the Americas through these companies in Ireland, which was nice for Apple because Ireland has a low tax rate. And what was nicer was that Apple didn't even have to pay that. And how could that be, if that's the rate that's payable in Ireland?
Well, I guess what is unusual is that the Apple subsidiaries are so-called stateless companies, incorporated in Ireland, but not resident in Ireland.
Apple was benefiting from a quirk of Irish tax law. It was using a technique known as the double Irish. It sounds like something you'd order in a bar, and when we explain it, you might think you've had a few drinks.
The Irish piece of the Apple is to say, look, under our rules, you're incorporated here, but our rules mean that you're not resident because you're not centrally managed and controlled in Ireland.
The head offices of the 2 subsidiary companies Apple had set up in Ireland were not officially resident in Ireland. And what's more,
while they were not resident in Ireland, similarly they were not resident in any other jurisdiction.
So these Apple companies operating out of Ireland were effectively based nowhere.
That does look somewhat unusual.
The European Commission certainly thought so. It started investigating, and it didn't like what it found, that Apple had been paying less than even 1% on profits made from sales in Europe in some years. So Apple had gone to Ireland in the first place because of the country's low tax rate, but in the end, it didn't even pay that.
The European Commission argued and delivered a ruling to say that this had provided Apple with a selective advantage.
That is, Ireland was offering the company a tax advantage not on offer to others.
And the quantification of that advantage was €13 billion.
A lot of money.
A lot of money plus interest. And Apple and Ireland have both appealed this ruling of the European Commission, and it will be heard by the European courts in due course.
However, Ireland has closed the double Irish loophole that allowed companies to be resident nowhere.
So the particular provision of Irish law that Apple had relied on was closed down by the then Minister for Finance.
What did Apple do? Remember that email asking lots of questions about tax havens? This is the moment in 2014 that it was sent. Yes, Apple went shopping for a new tax haven. Documents show that Apple picked Jersey as its new offshore base. Jersey offers foreign companies a corporate tax rate of 0%. Apple has defended its tax arrangements and says its effective tax rate on foreign earnings is 21%. And yet others say it's less than 5%. How can their numbers be so far apart?
I think this just kind of illustrates the complexity. So it's not that either figure is incorrect, it's just different methodologies.
Apple's higher figure includes money they've put aside to pay to US tax authorities. At this point, you might be wondering, if Apple is going to have to pay tax on all its foreign profits when it brings them home to the US, so that would mean 35% of the whole pie, minus any tax it's paid abroad, why would it go to all this effort to lower its tax rate overseas? Surely any win from a low tax rate abroad would be soon lost when the tax bill comes in from the US authorities. The answer is that Apple doesn't have to bring that money home. And it doesn't.
My understanding is that Apple has an enormous chest of money sitting offshore. One can picture Apple as being a seller of very desirable consumer goods with this enormous pot of money attached to it.
So where is this money? Let's go treasure hunting.
Part 3. Taxing the Pot of Gold.
Our third expert witness is Lee Shepherd, a contributing editor at the weekly journal Tax Notes International. Tax, she says, is something businesses really care about.
This is where companies, are worrying about their dollars and cents. This is where the rubber meets the road.
She speaks fluent accounting and legalese and makes light work of Apple's complex tax arrangements. Let's talk then about Apple's offshore cash.
Offshore in quote marks, yes. It's roughly $250 billion. And it's in dollars. And it's in Nevada in an in-house hedge fund.
See, I imagine that money was just sitting there in Ireland or Jersey somewhere.
No. Listen, rule number 1, okay? Multinational companies do not keep big bank accounts in tax havens. So Apple's cash stockpile is in the United States, in Nevada, where there's basically a big in-house investment fund that's handling it.
But the taxman can't touch it.
The taxman does not touch it because that money is treated as belonging to Apple's foreign subsidiaries.
In truth, we don't know where exactly the money is. The important thing for the US tax authorities is that the money has not yet been formally brought back to the country, what's known as repatriation. It's in dollar investments and is managed from Nevada, but it's deemed to be offshore. And that's all perfectly legal. Tax avoidance is largely a matter of paperwork. US tax rules state that a company can put off officially bringing home foreign profits to be taxed as long as it likes, and many companies put off that day indefinitely.
Some of these companies are going to owe something like the full 35% because they have paid very little tax elsewhere in the world, because they have intellectual property that they put in a tax haven, and they are able to sweep royalties out of their market countries into that tax haven. So you've done a whole selling job and earned billions of dollars, and you haven't paid any taxes so far.
US companies say they do want to bring home their foreign profits. As we've seen in the case of Apple, it can amount to a lot of money, and that money could be put to use in the US. The companies are waiting and hoping for a tax cut. Here's the Chief Executive Officer of Apple, Tim Cook, telling US broadcaster CNBC earlier this month what he thinks about the US tax rates applied on foreign earnings.
This is kind of a crazy thing to do. So this needs to be fixed. In my view, it should have been fixed years ago. but let's get it done now.
By fixed, he means cut. President Trump and Congress are planning some big changes to the US tax system to cut the 35% headline rate to 20%, so less of Apple's American pie would go to the tax collector. And they're also proposing a juicy one-off tax break on foreign profits. All that money which is considered offshore at the moment would be deemed onshore and taxed at a much lower rate than normal, something like 10%. And would that make Apple pay more tax?
In the short run, yes.
In the long run, though,
Can they keep just doing what they're doing? Yeah. And going forward, what they hope to have put in place is a territorial system.
under a territorial tax system, the foreign profits of US multinationals would be exempt from US taxation. So an American company could bring its overseas profits home without having to pay anything to the US tax collector.
Territorial system means zero on repatriation. So for the future, this is gorgeous for them.
The idea of this system is that it would remove the incentive to keep foreign profits offshore. A company wouldn't owe anything to the US tax collector on those profits, so it wouldn't have to be shy about bringing the money back home. However, Lee Shepard believes this wouldn't spell the end of tax avoidance.
It will encourage them to do it more. That's the dirty little secret, the dirty big obvious secret. It raises the stakes because you keep all of the benefits of your foreign tax planning. If you can plan down to zero, you get to stay at zero and owe nothing to the United States. So yes, you could even be more aggressive on that stuff.
Apple, like many companies, has a huge treasure chest of money offshore, profits earned abroad and kept abroad, until a day comes when the US decides to lower its tax rates. It looks like that day's almost here. And yet our expert witness believes this won't spell the end of corporate tax avoidance. Other changes to the US tax system, she says, will only further encourage it. So if the US rules aren't going to make Apple pay more tax in the long term, what are the prospects for a global approach?
Part 4. A fix.
I do have two little certificates on the wall, and they actually are beautifully designed. They have artwork on them, and they are nice.
Nice. These are Nobel Prize certificates. And certificates, plural. Professor Joseph Stiglitz, our final expert witness, has won the Nobel Prize not once, but twice. And now this internationally lauded economist has turned his award-winning intellect to the question of how to make big companies like Apple pay more tax.
They've managed to take advantage of globalization, basically to exist nowhere or to pay taxes nowhere. And while they thus take advantage of the resources our societies provide, they don't want to contribute back to society from which they're taking so much.
Apple says it's the world's biggest taxpayer. But Joseph Stiglitz says it and others should be paying more.
The problem is that over time, the companies have learned better and better how to avoid taxes. And so companies like Apple have used the same ingenuity that they used to make a smartphone to avoid paying taxes.
Do you think they put almost as much effort into avoiding taxes as they do developing their core product?
Oh, in some ways, more effort, and they made just as much profits out of it.
That's not what Apple CEO Tim Cook would say.
We don't depend on tax gimmicks.
Well, I don't know what you call it. The question is, if they're not using tax gimmicks, why are they locating in Ireland or in Jersey? Why not locate your business where the activity takes place? The activity takes place in the United States where a lot of the research occurs. The activity takes place in Europe where they sell their iPhones. Activity takes place in China where they manufacture it. If you're not engaging in tax gimmicks, why not register your profits where your profits occur?
To Joseph Stiglitz, the situation is clear.
The current system is broken, and there needs to be a new system.
He's on the panel of an independent commission looking at ways to fix the international corporate tax system. And he says they've come up with an idea that would see more countries get their fair share of tax payments from the multinational companies operating on their shores.
We're going to look at your global profits, and we're going to look at what fraction of your sales occurs in a particular country, say Great Britain, what fraction of your employees are located in Great Britain, what fraction of your capital stock is located in Great Britain, maybe what fraction of your intellectual property originated in Great Britain. So, and then you say that will determine the fraction of your profits that we attribute to Great Britain.
Could that work? Joseph Stiglitz says it already does, at a federal level in Canada, Switzerland, and even in fact the US. What do you think the prospects are then for your proposals being taken up? We could do it, but will we do it?
It is a matter of political will.
Is the political will there?
I think this is the moment. Multinationals like Apple have been excessively greedy. They, I think, have shot themselves in the foot by the magnitude of their greediness. Companies like Apple have been very, very open and say, we only do what the law allows us to do.
Why doesn't Apple pay more tax? All our expert witnesses say it's because it doesn't have to. Because the world's countries haven't worked together to design a system that gets more tax from the tech giant and others who arrange their tax affairs in the same clever way. In fact, it's countries that have really created the issue by competing with one another to bring business to their shores. And be under no illusion, Joseph Stiglitz says, this is a problem that needs to be fixed.
The magnitude of the tax avoidance activities by our corporations is enormous. We're not talking about a few dollars here and there. We're talking about hundreds of billions of dollars over a span of, say, 10 years. And the consequence of that is that our public services are starved, there are cutbacks, taxes have to be increased on ordinary citizens in one form or another. These are just the simple arithmetic of what happens when our large corporations like Apple don't pay their fair share.
The inquiry was presented by me, Ruth Alexander, and produced by Simon Mabin and Josephine Catherley. It was mixed by Rod Farker. The editor is Emma Rippon. If you enjoyed this, why not share it with your friends? And check out the documentary podcast from the BBC World Service. A recent episode, Namibia's Missing Millions, tells the story of how one of the world's biggest fishing companies shifted its profits away from Namibia into the tiny tax haven of Mauritius. And you can read many other stories that have emerged from the Paradise Papers on the BBC website.